The rally today, September 14th, was expected. Is it time to hedge? We've been calling for a high coming in between the 25th of September and the 2nd of October, saying that October would be a nasty month. And so far, our prediction is correct and the market's doing what we expected. However, at this point, it is very important not to get complacent. Because if indeed there's a large decline coming, you can't always anticipate it will come in exactly as expected. So the answer is take a look at some of these charts and you will see that some of the patterns we've been watching are extremely close to a big drop. Take a look at the 1929 market, which has been repeating at about a 77% level of correlation for the last 6 months. And we've been talking about that for a long time. And it indicates that we're about a week away from a high after which the market falls apart. Take a look at the 1994 market, which is the same position of Saturn, which is also highly correlated with the present market the last 6 months. And it is saying we're a few days away from a high and the market falls apart. Take a look at the 1987 market, and it says the market's right at the edge of the cliff and it's about to fall over the cliff. You'd find out about all this every week in our clinic. And our clinic is part of our forecasting course. So additionally, looking here at the 1967 market, which has been repeating for at least a year at a high correlation level, and it also indicates the market is about to fall. It may go up to the end of the month and it may not, and then it falls fairly hard. Okay, so there we have 4 examples of markets that have been correlated well with the present. All of them indicate the market's going to go down soon. And so at this point, you have to start becoming careful. Oftentimes, you can be off by a day or two and miss a huge move. So I'd start tightening up stops, being very careful. Any moves that come further, consider where is the resistance and what likely is the price objective of those moves. So to look at that next, we look at our matrix channels, which are highly reliable proprietary technique where we anticipate the proper price levels where markets will run into resistance. And these levels are not available elsewhere because we invented this technique. Now notice, directly above the market, there are 5 parallel lines. There are 5 resistance levels. They range anywhere from the 45.45 area, which we've already exceeded. The S&P closed today at 45.58, and all the way up to 45.87. Usually, it is difficult for the market to break through that many lines. Therefore, that area of resistance is a highly likely target area for this move up. The other thing that's there is the timing angle. You noticed last month we saw that the timing angle triggered the buy point that allowed us to go long. And this time, the timing angle is saying that we're approaching and we're already entering the region of those 5 horizontal lines, triggering, in the Gann terminology, the beginning of a trend change. That trend change could still have a few days left, but it's coming close. And the price of the market, as it gets up into that region, will allow time and price to balance, which would mean that when time and price are in balance, change is imminent. We're very close to that point. So at this point, we're still bullish, but we're being cautious. Higher prices are still likely, but if they don't happen, you have to be prepared to quickly reverse your position and get either out of the market or get short if it breaks below the most recent lows that it has made.